Hey investors, welcome back to Markets and Lasers. Whether you are new to the world of finance or just looking to sharpen your skills, today's video is all about the most important financial documents you will ever come across, the income statement. Now, don't worry if numbers aren't your thing. We are going to break it down in a way that's super easy to understand. Get comfortable and let's dive into it. So you might be wondering, why should I care about the income statement? Well, whether you are an investor trying to decide if a stock is worth your money, a business owner looking to understand your company's performance, or just someone curious about how business operates, the income statement is your go-to report. It's like the report card for a company showing how much money it's making, what it's spending on, and what's left over, the profit. Think of the income statement as a story. It's a story of how a company earns and spends money over a specific period, like a quarter. It means every 3 months or a year. And just like any good story, it has its key characters: revenue, cost, and profit. Before we get into the nitty-gritty details, let's take a moment to appreciate why this story is so crucial. Imagine you are thinking about investing in a company. You wouldn't want to put your money into something without knowing how well it's doing, right? The income statement gives you that insight. It helps you see if the company is growing, if it's managing its expenses well, and if it is actually making money at the end of the day. It's like having a backstage pass to the company's financial health. Even if you are not into stocks or finance, understanding the basics of an income statement can be a game changer. Whether you are evaluating a job offer from a company, considering starting your own business, or just curious about how big companies like Apple or Tesla are performing, or even how small shops around you are doing their work. This is the kind of knowledge that gives you an edge. So, what's on the agenda today? We will walk through what an income statement is, break down its key components like revenue, expenses, and net income, and even look at some real world examples to see how it all comes together. By the end of this video, you will be able to read and understand an income statement like a pro. And who knows, maybe you will even find it kind of fun. Alright, enough of the intro. Let's get started with the basics. After explaining the basics, we will apply everything we learned on a real company so we will get even more clarity. All you have to do is watch the video till the end. And if you at any stage found the video informative, don't forget to like and subscribe. This is the overview of what you will learn in this video. Let's go then. What exactly is an income statement? Now, if you are not a finance person, the term income statement might sound a bit intimidating, but it's really just a fancy word of saying profit and loss statement. In simple terms, it's a report that shows how much money a company made and how much it spent and how much it kept as profit during a specific period, like a quarter or a year. Think of it this way: the income statement is like a detailed financial diary for a company. Just like you track your own income and expenses to see how much you can save or spend, a company uses the income statement to track its financial performance. It tells the story of the company's financial journey over a specific time frame. Now, this financial diary has three main sections: revenue, expenses, and net income. Revenue is all the money the company brings in from selling its products or services. It's the top line, also known as the gross income. Next, we have expenses, which are all the costs the company incurs to keep its operations running. Things like salaries, rent, and utilities. And finally, we have net income, which is what's left after all the expenses are paid. This is often referred to as the bottom line because, well, it's literally at the bottom of the statement. Here is a little analogy to make it even clearer. Imagine you run a tea shop. The money you make selling cups of tea is your revenue. Every cup you sell adds to your revenue stream. But of course, you have expenses too. You need to buy tea powder, sugar, milk, cups, and pay for things like rent and electricity. All these costs are your expenses. Whatever money is left after covering the cost is your net income or profit. It's like saying after all the bills are paid, this is what left for you to take home. It's the same concept for companies, just on a much larger scale. But why is this important? Well, the income statement gives investors and stakeholders a snapshot of the company's financial health. Are they making more money than they are spending? Are they growing their revenue over time? Or are they cutting costs effectively? These are the kind of insights you can get from an income statement. And here is another cool thing. Income statements aren't just for big corporations. Small businesses, startups, even your personal finances can benefit from this kind of tracking. It's all about understanding where the money is coming from and where it's going. After watching this video, try to make your personal income statement as well. It can be really helpful. So in a nutshell, the income statement is a key tool in the financial toolkit. It helps you see the bigger picture of a company's financial performance. And trust me, once you get the hang of reading this, you'll find it's not as intimidating as it seems. In fact, it can be quite empowering. Alright, now that we have got the basics down, let's dive into the juicy details. We will break down each component of the income statement, starting with revenue. Alright, let's get into the heart of the income statement, the key components. These are the building blocks that tells us how a company is performing financially. Think of it like cooking a dish. You have your main ingredients and each plays a crucial role in the final taste. The income statement is similar. It has several key components that together tell the story of a company's financial health. Let's break them down. First up, we have revenue, also known as sales or the top line. This is all the money a company brings in from selling its products or services. It's like the cash register ringing up every sale, whether it's cup of tea at a tea shop or electric power sold by Tata Power. Revenue shows us the total income before any expenses are deducted. It's a crucial number because it indicates the company's ability to generate sales. For example, if you own a tea shop, your revenue would be the total amount of money you make from selling tea. So if you sell 1000 cups at 10 rupees each, your revenue is 10,000 rupees. Next, we have the cost of goods sold, or COGS, COGS. This represents the direct cost associated with producing the goods and services sold by the company. For our tea shop, COGS, cost of goods sold, would be, it includes the cost of tea powder, sugar, milk, cups, and any other materials used to make the tea. It's important because it helps determine the gross profit by showing how much it costs to make the products that are sold. If you see an example, in our tea shop, if the ingredients for making 1000 cups of tea cost, let's say around 4000, then 4000 is our COGS, cost of goods sold. Next is gross profit. It is calculated by subtracting COGS from revenue. It tells us how much money is left over after covering the direct cost of production. Gross profit is a key indicator of a company's efficiency in producing its goods and services. The higher the gross profit, the more money the company has to cover other expenses. So if you see an example, if your revenue is, let's say 10,000 in our case, and our COGS is 4,000, your gross profit is 6,000. If we subtract 4,000 from 10,000 and get 6,000. This means you have made 6,000 from selling tea after accounting for the cost of ingredients. Now let's talk about operating expenses. These are the costs required to run the business that aren't directly tied to producing goods or services. Operating expenses include things like salaries, rent, utilities, marketing, and administrative cost. For our tea shop, this could be the rent for the shop, wages for employees, and the cost of advertising. These expenses are necessary to keep the business running smoothly. If you see an example, if you pay 2,000 in rent, 1,000 rupees in salaries, and 500 for utilities and marketing, your total operating expenses would be 3,500. Next, operating income. It is also known as operating profit. It's what left after subtracting operating expenses from gross profit. It shows how much profit a company makes from its core business operations without considering other income or expenses. Operating income is a key measure of company's operational efficiency. Using our tea shop, if your gross profit is 6,000 and your operating expenses are 3,500, your operating income would be 2,500. This means you made 2,500 from the core business of selling tea after covering all operational costs. Besides the main business operations, companies often have other sources of income or expenses. These can include things like interest income from investments, gains or losses from the sale of assets, or interest expenses on loans. This section also accounts for any unusual or non-recurring items that don't fit nearly into the main categories. Example, imagine your tea shop had a small investment in a local cafe that paid you 500 rupees in dividends. That 500 is considered as other income. If you had a loan and you paid 300 rupees in interest, that would be listed as another expense. Finally, we get to the net income, also known as the bottom line. Write this word net income 5 times, 10 times. It's the most important word you should learn. It should be in your memory. This is the total profit after all expenses, including COGS, operating expense, and other income and expenses have been deducted from revenue. Net income is a crucial figure because it shows the company's overall profitability. It's the amount that ultimately goes to the shareholders or gets reinvested in the business. So if you see an example, if your operating income is 2,500 and you have 500 in other income and 300 in other expenses, so net income would be 2,700. So take that operating income 2,500 and add other income of 500 and subtract your other expenses of 300. You will get 2,700. This means after all cost and expenses, you are left with 2,700 in profit. To sum it up, the income statement is a powerful tool that breaks down a company's financial performance into understandable sections. From revenue to net income, each part gives us insight into how well the company is doing financially. Understanding these components helps us get a cleaner picture of company's profitability and efficiency. Next up, we will dive into a real world example and see how these components come together. It will be very, very interesting. Don't go anywhere. We have spoken how they work in a tea shop. Now let's take a real company. You can take any company of your wish. I will take Tata Power to explain. Leave this only for explanation purpose. You can see it is their consolidated statement of profit and loss, which is nothing but income statement. You can find them in the company's annual report. I'll give the PDF link to their annual report so you can download as well. If you look at the statement, the subheadings are marked in bold color. Look at total income, expenses, profit or loss. All these are the main things you should understand. Don't get intimidated. Just stay around. This column indicates Tata Power numbers from 1st April 2023 to 31st March 2024. Everything they done in this time period will be recorded here. Similarly, this column says it's for the year ended March 31st, 2023. It means April 1st, 2022 to 31st March 2023 numbers. For this video, we will focus only on recent numbers. It means this blue column for the year ended March 31st, 2024. All these numbers you see are mentioned in crores. First, to begin with revenue from operations. It came at 61,448.90 crores. It means in the FY24, the total money the company made from their business operations is approximately 61,448 crores. Tata Power is a big company. They do business in various segments like power generation, power transmission, power distribution, and they also sell renewable energy to others. So from all these businesses, they got 61,448 crores to the company. Next, in the same section, we got other income, which is worth 1,823.42 crore. The other income, it's the money they got away from their business operation. For example, they might have some money in their corporate bank account. They will receive interest on that, and they might have also received dividends from other joint ventures. You don't have to worry too much about this. Just keep your focus on the income from operations. This other income is like a kind of additional source or bonus. If we add both of them, we get 63,272.32 crores. It's the total income. I hope you are clear about income. Next, we are moving on to expense segment. The expenses can be divided into two types. The first one, cost of goods sold. Next, second one, operating expenses. Both will come under the expenses only, but we will just try to understand what type of expense it is. First, COGS, cost of goods sold. It means the direct cost attributed to the production of power or for distribution and transmission. The kind of cost they incur to run the business comes under COGS. If you did not understand here, I told you, for tea shop, COGS would include the cost of tea powder, sugar, milk, cups, and any other materials used for making the tea. The COGS are direct cost associated with business of a company. For example, all these things for Tata Power comes under COGS. Things like cost of power purchased, cost of fuel, raw material consumed, purchase of finished goods, increase in stock trade, work in progress. Without these expenses, you cannot produce or transmit the power. Those comes under COGS. Those expenses comes under COGS. The next is operating expense. You will get full clarity here. These expenses, the operating expenses, are necessary for day-to-day functioning of the business. It's like giving salary to the employees or paying interest to loans if we have any. So these kind of expenses comes under operating expenses. Before showing you what comes under operating expenses, can you tell me how much is operating expense if total expense is 59,084.66 crores? I just want you to answer before moving on. Try to pause the video and answer below in the comments. Just take total expenses and subtract with COGS. You will get operating expense. If any expenses which is not covered under COGS will come under operating expense. So the remaining things after COGS expenses are accounted is transmission charges, employee benefit expenses, finance cost, depreciation and amortization expenses, and other expenses. So until now, we have learnt about income and expenses. In expenses, there are two types. One is cost of goods sold. It is the direct cost associated with the business of a company. The next is operating expenses. It is like day-to-day expense. Friends, if you really enjoyed the video until this point, do hit the like button, share the video with your friends to whom it will be useful. And finally, if you haven't subscribed yet, do it fast. There is some exciting content coming up. Let's get back to the video. If you are clear until this point, it means you have learned 70% of the income statement. With the knowledge we have, we can calculate some of the most important stock ratios. First, gross profit. The formula is total income minus cost of goods sold. So take total income and subtract with cost of goods sold, we'll get 23,699.42 crore. This is the amount of money a company makes from its core business operation. To calculate gross profit margin, just take gross profit by total income and multiply it with 100. So if you take that, the gross profit is 23,699.42 crore divided by 63,272 crores. If you multiply by 100, we will get 37.45%. The gross profit margin of 37.45% means for every 100 rupee of revenue generated by Tata Power, the company retains 37.45 as gross profit after removing the expense cost associated with producing and selling its products or services. Next, we will calculate operating income. Operating income is also known as operating profit. It represents the profits earned from a company's core business operations, excluding non-operating items like interest, taxes, and exceptional items. It indicates the company's ability to generate profits from its main activities. The formula to calculate is gross profit minus operating expense. The gross profit is 23,699 crore minus operating expense, which is 19,511 crores. We will get 4,197 crores. With this operating profit, we can calculate operating profit margin. So take operating income, divide it by total income and multiply by 100. We will get 6.62%. The operating profit margin of 6.6 means for every 100 rupees of revenue generated, the company earns 6.6 rupees as operating income after deducting operating expense. Before moving on to the final part, I will once again tell the terms we have learned. First, total income. Second, expenses, which is divided into two types. One is COGS, cost of goods sold. The next one is operating expenses. With this, we can calculate gross profit and gross profit margin. And finally, we learn to calculate operating profit and operating profit. Next, all these total movement in regulatory deferred balances and below the share of net profit, equity method, all this comes under income and expenses. It means they are not directly related to the company. Let's calculate this. If we add all these three, we will get 93.43 crore. This also comes under other expenses and it comes around 1,177 crores. And finally, add these exceptional items, it comes at 273 crore. So if we add all these numbers, we will get 1,544.36 crores. We don't have to give much importance to this other income and expense section because they don't impact the business. If we add this income to our operating income, we get 5,732 crores. This is the profit of the company before paying taxes to the government. If we take the taxes out, we will get final profit that shareholders get, the business owners get. So if we calculate tax, the tax comes around 1,451.92 crore. So if we subtract tax from this total amount, we get net profit, which is 4,280.10 crore. This is the number for which the company has been working throughout the year. This is the amount we can take home if you want, or else we can invest back in the business, or we can do both. We can take some part of that 4,280 crore and we can invest the remaining part back into the business. That's what even most of the companies do. So friends, first we spoke about total income, which is worth 63,272 crores. Next, COGS, which is worth 39,572 crores. Next, gross profit, which equals to 23,699 crore. Then operating expense, it came at 19,511 crores. Then operating income, which came at 4,187 crores. Then other income and expenses came at a positive number of 1,544 crore. So if we add this other income and expenses to operating income, we get profit before tax, which is at 5,732 crores. Finally, after taking tax, we get the net profit of 4,280 crores, which is all ours. It means it is all shareholders' money. With the net profit, we can calculate net profit margin. The formula is net profit divided by total income into 100. What's our net profit? It is 4,280.10 crore divided by total income, which is 63,272 crores. If we multiply by 100, we will get net profit margin of 6.7. A net profit margin of 6.7 means for every 100 of total income the company gets, the company earns a net profit of 6.7 rupees. I hope you are very clear about the income statement. I would encourage you to do it yourself. For the companies who like, follow the same method which I showed to you. Banks might say net interest income, others might say net income, but the essence is same. Different sectors call it differently, but the way in which you should understand the income statement is same. Next, let's move on and learn how to use income statement for analysis. Don't go anywhere. This is where the video will get interesting. As we learned how the income statement works, but how to use it for our advantage. Let me explain. Here is how you can use it to get some valuable insight. First, assessing revenue growth. Check out the revenue or sales section. This shows how much money the company bought in from selling its products or services. You can compare the revenue from different periods to see if the company is growing. For example, if Tata Power had a revenue of 63,272 crores this year and it was 56,547 crores last year, that's a good sign. It means the company is making more money from its core business activities. Next, look at the different profit margins. Start with the gross profit, which we learned how to calculate. This tells you how efficiently the company is producing its goods. A higher gross profit margin means the company is keeping good chunk of its sales after covering production cost, which is a positive sign. Then move on to operating profit, which accounts for operating expenses like salaries, rent, and utilities. This shows how well the company controls its operating cost. Finally, net profit or bottom line gives you overall profitability after all expenses including taxes and interest are deducted. Expenses are a crucial part of income statement. High expense can eat into profits, so it's essential to see how well the company is managing its cost. Look at different categories like operating expense, finance cost, and depreciation. If these are rising faster than revenue, it might be a red flag that company is not managing its cost effectively. Next, understand gross profit margin, operating profit margin, and net profit margin. These ratios help you compare profitability across different companies. And finally, an income statement doesn't exist in vacuum. To get the full picture, you should also look at balance sheet to understand the company's financial position and the cash flow statement to see how well the cash is being generated and used. But the income statement is a great starting point to see how well the company is doing in generating profits from its operations. We will learn balance sheet and cash flow in upcoming videos. So in summary, the income statement is like a report card for a company's performance. It tells you how much money came in and how much went out and what's left over as a profit. By analyzing it, you can get a good sense of the company's health and profitability. This is the most important part in this video. The common pitfalls and misconceptions in analyzing income statements. If you understand this part clearly, then you are truly a pro in analyzing income statements. I will just tell 2 points here, so you just keep an eye on them. There is a misconception that when some people see a spike in profit and think the company is doing great, but sometimes this can be due to one-time gains like selling an asset or a legal settlement, which aren't part of the company's regular operations and won't occur every year. For example, if Tata Power reports a big gain from selling a piece of property, that gain will boost the profits for that year. But it isn't something you can expect every year. It's important to separate these one-time items to get a clear picture of the company's ongoing profitability. This is something you should keep in mind. Are there profits coming from business operations, or is there some one-time gains? The other misconception is thinking that revenue growth is always good. Not necessarily. It's crucial to look at the quality of revenue. What is quality of revenue? It means, is the revenue coming from its core operations? Are there large contributions from non-operating sources? For example, if a significant portion of Tata Power's revenue comes from a one-time government subsidiary or a large project that won't happen again, it might not indicate sustainable growth. It is also similar to the earlier misconception, so you should see whether the revenue is coming from the core business or not. Understanding these pitfalls and misconceptions helps provide a cleaner and more accurate picture of a company's financial health. I want you to understand these two main mistakes. Always look deeper than the surface numbers. Consider the context and don't rely solely on one metric. This holistic approach will give you a better understanding of a company's true performance and potential. You won't understand everything clearly in the beginning itself. Keep on practicing, you will definitely become better. In this deep dive into the income statement, we have explored the essential components, practical examples, and analytical techniques to understand a company's financial health. The income statement is more than just a list of numbers. It's an important tool that tells the story of company's operations, profitability, and efficiency. From breaking down revenue and expenses to discussing common pitfalls and misconceptions, we have covered how each part of the income statement contributes to the overall picture. We have learned to differentiate regular and one-time items. Remember, the income statement is just one piece of the financial puzzle. For a comprehensive analysis, it should be used in combination with the balance sheet and cash flow statement, which will be discussed in upcoming videos. So what you have to do is, don't forget to like, subscribe, and hit the notification bell if you found this content helpful. Share this video with your friends to whom it might be beneficial. Let's spread the knowledge and empower more people to make informed financial decisions. As you continue your journey in financial analysis, keep these insights in your mind and always look behind the surface. A thorough understanding of the income statement can empower you to make informed decisions, whether you are an investor or a business owner or simply someone interested in the financial workings of a company like Tata Power. Happy analyzing and always stay curious. Thanks for watching and see you in the next video.